Title: The Intelligent Investor, In-Depth Summary. Author, **** Benjamin Graham. Summary. Introduction. The Intelligent Investor, by Benjamin Graham, is considered one of the most important books on investing ever written. First published in 1949, the book remains relevant today due to its timeless wisdom and principles. Graham's philosophy, commonly referred to as value investing, focuses on the importance of analyzing companies and stocks based on their intrinsic value, rather than speculation or market trends. Chapter 1: Investment vs. Speculation. Graham distinguishes between investment and speculation. An investor focuses on the long-term intrinsic value of a company, while a speculator attempts to profit from short-term market fluctuations. Graham advocates for a defensive and conservative approach to investing, emphasizing the importance of thorough analysis and risk management. Chapter 2: The Investor and Inflation. This chapter discusses the impact of inflation on investments. Graham advises investors to consider the effects of inflation and to choose investments that can withstand its erosion of purchasing power. He suggests investing in stocks that have a history of maintaining their value over time. Chapter 3: A Century of Stock Market History, The Level of Stock Prices in Early 1972. Graham reviews the history of the stock market and analyzes the levels of stock prices. He emphasizes the importance of avoiding speculative behavior and focusing on long-term value. Graham provides insights into market cycles and the irrational behavior of investors during bull markets. Chapter 4: General Portfolio Policy, The Defensive Investor. Graham introduces the concept of the defensive investor, someone who prioritizes safety and freedom from the need for market timing. He recommends a defensive investor to allocate their investment portfolio in a diversified manner, with a focus on high-quality, low-risk stocks and bonds. Graham also discusses the difference between defensive and aggressive investment strategies. Chapter 5: The Defensive Investor and Common Stocks. In this chapter, Graham discusses the criteria for selecting common stocks for the defensive investor. He emphasizes the importance of a company's financial stability, its dividend record, and its earnings stability. Graham introduces his concept of margin of safety, which he defines as the discount from the intrinsic value at which the stock is selling. Chapter 6: Portfolio Policy for the Enterprising Investor, Negative Approach. Graham focuses on the portfolio policy for the enterprising investor. He introduces the concept of a negative approach, advising investors to exclude companies that do not meet certain criteria. He suggests excluding companies that are too small, too cyclical, or too highly leveraged. Chapter 7: Portfolio Policy for the Enterprising Investor, The Positive Side. Graham continues to discuss the portfolio policy for the enterprising investor, this time focusing on the positive side. He advises investors to actively seek out opportunities and suggests a more active approach to portfolio management. He emphasizes the importance of a thorough analysis of each potential investment. Chapter 8: The Investor and Market Fluctuations. This chapter explores the psychological aspects of investing, particularly the impact of market fluctuations on investor behavior. Graham advocates for a disciplined approach to investing and advises investors to remain rational and unemotional, especially during periods of market turmoil. Chapter 9: Investing in Investment Funds. Graham discusses the advantages and disadvantages of investing in investment funds, such as mutual funds. He provides guidelines for selecting the right investment fund, emphasizing the importance of low fees, a conservative investment policy, and a long-term track record. Chapter 10: The Investor and His Advisors. Graham discusses the role of investment advisors and the importance of choosing the right one. He advises investors to be cautious and to avoid advisors who promise high returns or employ speculative strategies. Graham stresses the importance of understanding one's investments and being actively involved in the decision-making process. Chapter 11. Security Analysis for the Lay Investor, General Approach. This chapter introduces the basics of security analysis for the lay investor. Graham explains the difference between fundamental and technical analysis and emphasizes the importance of understanding the underlying business of a company before investing in its stock. Chapter 12. Things to consider about per-share earnings. Graham discusses the significance of per-share earnings in evaluating a company's performance. He explains how to properly interpret earnings data and warns investors against placing too much emphasis on short-term fluctuations in earnings. Chapter 13. A comparison of 4 listed companies. Graham provides a detailed comparison of 4 different companies to illustrate the principles of security analysis. He examines their financial statements, earnings records, and stock prices to demonstrate how to evaluate the intrinsic value of a company. Chapter 14. Stock Selection for the Defensive Investor. This chapter provides a step-by-step guide to stock selection for the defensive investor. Graham outlines specific criteria for evaluating stocks, including the company's financial stability, earnings record, and dividend history. Chapter 15. Stock Selection for the Enterprising Investor. Graham discusses stock selection for the enterprising investor, who is willing to put in more effort to achieve higher returns. He advises investors to look for undervalued stocks and provides a framework for evaluating potential investment opportunities. Chapter 16. Convertible Issues and Warrants. This chapter explores the advantages and disadvantages of convertible securities and warrants. Graham explains how these securities work and advises investors on when and how to incorporate them into their investment portfolios. Chapter 17. 4 Extremely Instructive Case Histories. Graham presents 4 case histories of different types of investments to illustrate the principles discussed in the book. He analyzes each case in detail, highlighting the key lessons that investors can learn from them. Chapter 18. The Investor and Market Fluctuations. Graham revisits the topic of market fluctuations and discusses the psychology of the market. He emphasizes the importance of maintaining a long-term perspective and avoiding emotional reactions to short-term market movements. Chapter 19. Investing in Investment Counselors. Graham provides guidance on how to select an investment counselor or advisory service. He advises investors to choose a counselor with a conservative investment approach, a long-term track record, and low fees. Chapter 20. The Investor and His Own Personal Psychology. In the final chapter, Graham discusses the importance of understanding one's own psychology as an investor. He emphasizes the need for discipline, patience, and a rational mindset when making investment decisions. Conclusion. The Intelligent Investor, by Benjamin Graham, is a timeless guide to value investing. By focusing on the long-term intrinsic value of companies, rather than short-term market trends, investors can build wealth steadily and reduce their risk of significant losses. Graham's principles of value investing remain as relevant today as they were when the book was first published. With the right mindset, discipline, and a commitment to thorough analysis, investors can navigate the complex world of investing with confidence and success.